For most of your life, things are pretty predictable. You go to work, you get a paycheck, it's a rhythm. But then you retire, and that rhythm just stops. All of a sudden, the big question isn't about how to grow your money anymore, it's about how to actually live on it. So today, let's break down how you can turn that nest egg you worked so hard for into a reliable paycheck that lasts. So, this is the big question, right? It's the one every single retiree has to figure out. Your whole mindset has to shift from growth to income, from building the pile to creating a steady stream of cash you can count on. But here's the thing. As we're about to see, some of the most common ways people try to do this are packed with serious and often totally hidden risks. All right, so before we get to the good stuff, we've got to talk about the problems. Let's dive into three really common and honestly pretty risky portfolio mistakes that can really jeopardize your financial security, right when you need that security the most. Understanding these is absolutely the first step to avoiding them. Okay, mistake number one. This one's a classic. Loading up on those dividend-paying stocks in what you think are safe, high-quality bond funds. I mean, it sounds perfect, doesn't it? You get regular income from solid assets. What could possibly go wrong? Well, the problem isn't the little bit of income you get. It's the wild swings in the value of the investments themselves. And look, this is not some newfangled idea. We're talking Benjamin Graham, the literal father of value investing, saying this almost 100 years ago. The logic just feels so solid. A good, healthy company should share its profits. And that's exactly why dividend investing is so popular. It feels safe, it feels productive. But that feeling, well, it can be dangerously misleading. And that's where we run into a really nasty surprise, what's known as a dividend trap stock. You see, you can find a fantastic company, great business, making tons of cash, paying a steady dividend. But if Wall Street has bid up its stock price to the moon, any little hiccup can send that price plummeting and poof, years of your dividend income are wiped out in an instant. This is so important. It can be a great company, but a terrible stock. And we're not talking about some obscure fly-by-night companies here. According to a report from New Constructs, we're talking about household names like WD-40 and ADP. These are solid businesses, for sure, but their stock valuations are just so high that the tiny dividend yield doesn't even come close to making up for the risk of a huge price drop. It's like picking up pennies in front of a steamroller. This whole issue for both dividend stocks and bond funds really boils down to one thing: price volatility. Because you have to sell your shares to get your money, you're completely at the mercy of the market's mood swings. Just look at this. You have Howard, who puts 10 grand into a bond fund, and a year later, he's lost 13% of it. Then you have Suzanne, who puts her money in the exact same fund just 1 year later, and she's up 8.5%. The lesson? You have zero control over what your investment is worth on the day you actually need to sell it. Okay, so after seeing something like that, what's your first instinct? It's to run for cover, right? You say, forget this, and you pull your money out and just park it in cash, or maybe some really short-term bonds. And yeah, that definitely gets rid of that scary price risk, but it opens you up to a totally different and frankly equally dangerous problem. And that problem has a name. It's called reinvestment risk. Let me paint a picture for you. Let's say you're feeling great today, earning a nice 4% on your safe short-term stuff. But when those investments come due in a year, what happens if interest rates have crashed down to 2%? Just like that, the income you were counting on from that money gets cut in half. For a retiree on a fixed income, a shock like that can be absolutely devastating. All right, mistake number 3. This one's a little different. It's less about your spreadsheet and more about what's going on in your head. It's that deep, gut-level fear of touching your principal. So many retirees think the absolute safest thing to do is to live only off the interest or dividends and never ever dip into that original nest egg. And it sounds so responsible, but it can actually backfire, big time. There's a perfect analogy for this. Refusing to spend your principal is like owning a car but never driving it because you're afraid of using up the gas. It doesn't make any sense. You worked your entire life to save this money. The whole point is to use it, to fund an amazing retirement, not to just stare at it. Guarding it too much can actually lead to you underspending and having a lower quality of life than you've earned. Okay, enough with the doom and gloom. We've talked about price risk, reinvestment risk, and this fear of spending. Now, let's finally turn the corner and talk about the solution, a time-tested strategy that directly tackles all 3 of these problems. It's called the bond ladder. The concept here is it's beautifully simple, really. Instead of buying a fund where you own a tiny slice of 1,000 bonds, you own a handful of individual bonds that mature in different years. So you might own one that comes due in 2026, another in 2027, one in 2028, and you just keep going. Each year, one rung of your ladder matures, and you get your original investment, your principal, back. The key word here isn't performance, it's predictability. You know exactly how much money is coming back to you and exactly when. So let's connect the dots. How does this simple structure actually fix those three big problems we talked about? This is where the real power of the bond ladder starts to shine through. First up, price risk. Remember our friend Howard who lost 13% in his bond fund? With a bond ladder, that problem it vanishes. You don't sell the bond to get your cash back. You simply hold it until it matures, until it comes due at its full face value. It completely insulates you from market chaos. You are never forced to sell your assets at a loss just to pay for a new roof on the house. Next up, reinvestment risk. By buying bonds that mature over several years into the future, you get to lock in today's interest rates for the entire life of those bonds. You're no longer at the mercy of whatever the Federal Reserve decides to do next year. A big chunk of your income stream is secured for 5, 10, maybe even more years, and that gives you incredible peace of mind. And finally, we get to that fear of spending. A bond ladder totally reframes how you think about using your principal. It transforms it from this scary, emotional decision into a planned, disciplined, automatic process. Each maturing bond is just a scheduled return of your own capital. It's built right into the strategy, basically giving you permission and a clear plan to use the money you saved for its intended purpose. Now, at this point, you might be thinking, okay, this sounds pretty great, but buying a whole bunch of individual bonds, that sounds really complicated and probably expensive. And you know what? Historically, you would have been absolutely right. But things have changed in a big way. The old way of doing this was, frankly, a huge pain. It was manual, it was tedious, and you often needed a lot of money to even get started. But today, financial innovation has given us these amazing tools called bond ladder ETFs. They essentially give you a fully built, professionally managed bond ladder in a single trade. It's as easy as buying a stock. They take all that complexity and just wipe it off the table, making this incredibly powerful strategy accessible to pretty much everyone. So if there's one thing to take away from all this, it's this. In retirement, uncertainty is your enemy. Any strategy that relies on unpredictable market prices is introducing risk right at the moment you can least afford to take it. A bond ladder, on the other hand, is designed from the ground up for one thing, to deliver a predictable stream of cash flow. It turns a piece of your nest egg into your own personal, predictable paycheck. And when you're retired, what could possibly be more powerful than that?